Well, hi, I'm Taejun, and welcome to TJ's Macroeconomy. Within the financial system, there are some challenges, and in response, financial institutions find a way to overcome these challenges. So in this video, I'm going to talk about the challenges faced in the financial system and solutions to such challenges. First, I'd like to talk about the four types of challenges. 1. National cost. 2. Transaction cost. 3. Financial risks. And lastly, liquidity. First challenge within the financial system is national cost. A national cost, by definition, is an interest rate that must eventually be paid to a foreign country. So basically, if money comes to a country from a foreign country, which is a capital inflow, the money needs to be repaid with interest rate to that foreign country. So due to that interest, the national cost would rise. The second challenge within the financial system is transaction cost. Transaction costs are costs of making a deal. Transaction costs are not only just interest rates that one gets charged with, but they are also a time and effort that go into trying to negotiate the deal. One special case happens in a loan from a bank, where obtaining a loan from a bank avoids large transaction costs. This is basically because it involves only a single borrower and a single lender. The third challenge is financial risks. Financial risks are uncertainties about future outcomes. So you basically do not know what would happen to your deal on assets that you choose to invest on. Financial risks vary based on types of assets. For stocks, they offer higher risk because a company may go bankrupt and you would lose the hold on that company's stock. Loan to a bank, however, deals with fairly low risks. There are two reasons behind this. First, banks simply do not go out of business often. Even if it happens very rarely. Second, even if the bank, for example, goes bankrupt, the investors are safe because there are fail-safes that would protect and ensure the money loss. One example of fail-safe in the United States is a FDIC, which stands for Federal Deposit Insurance Corporation, that would insure up to $250,000 if bankruptcy happens. Bond in specific has a risk so-called default. A default happens when bond issuer is not able to pay the money back. So for example, if I bought a bond from Dennis, but I could not afford to pay Dennis back the money, then that is simply a default. Lastly, we have liquidity. Liquidity is an economic term used to determine how easily can an asset turn into cash without the loss of value. We call it liquid when an asset is easy to be changed into a cash, and illiquid when it's basically the right opposite to an asset being liquid. Liquidity also varies depending on the types of assets. A stock is usually liquid because we can sell stocks easily and make them into a cash. A loan to bank is also liquid because it is easy to turn the deposits into cash. Bonds, however, are illiquid because there is a promised expire date on bonds where we people basically have to wait until the certificate expires. Now that we know some of the main challenges in the financial system, let's talk about some ways financial intermediaries solve them. There are three main solutions that I want to talk about. 1. Buying insurance, and 2. Reducing transaction costs, and 3. Diversification. Financial intermediaries deal with risks by buying insurance. The general feature of insurance contracts is that a person facing a risk pays a fee to an insurance company, which in turn agrees to accept all or part of the risk. So basically, through insurance contracts, bank deal such risks. The second solution is reducing transaction costs. But how would this be achieved? Well, this can be accomplished as a well-functioning financial system facilitates investment spending by allowing companies to borrow large sums of money without incurring large transaction costs. The last solution is diversification. Diversification refers to the reduction of risk achieved by replacing a single risk with a large number number of smaller, unrelated risks. Diversification is probably the best way to be able to spread out risks, because through diversification, people do not put all the eggs in one basket. And what I mean by this is that by putting money in many different assets, one does not have to worry when an asset drops or fails, so you won't lose all the money, even if an asset drops or fails. So to sum up all, a well-functioning financial system would basically do three main jobs. Number one, on decreasing transaction costs, two, decreasing risks, and three, providing liquidity.